Hey friends, are you tired of watching your money sit idle while inflation eats away at your purchasing power? Most investors think they need to choose between growth and income, but what if I told you there's a way to get both? Today, we're diving into 4 Singapore REITs that could be your ticket to steady dividends and capital appreciation in June 2025. Before we jump in, I want to share something exciting with you. Want to access premium content before it's made available to everyone else? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily market analysis, early insights into promising trends, and deeper dives into specific investment strategies. Think of it as your daily dose of financial fuel. Just click on the membership tab to join us. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we'll explore why REITs are bouncing back, examine 4 standout Singapore REITs making smart moves, and discover how you can position yourself for success in this recovering sector. The REIT landscape has completely transformed. Think of 2022 and 23 as a brutal winter for REITs. High interest rates and inflation hit them like a double punch. But now, we're seeing the first signs of spring. Interest rates are cooling down. Inflation has dropped from its scary 2022 peaks. REIT managers aren't sitting idle either. They're actively reshaping their portfolios like master chefs perfecting their recipes. The numbers tell the story. Singapore REITs are now trading at attractive valuations. The sector trades at around 0.8 times price-to-book ratio, with many S-REITs trading below their net asset value. This creates a perfect storm for value investors. You're essentially buying dollar bills for 80 cents. Let's start with our first powerhouse, CapitaLand Ascendas REIT, or CLAR as we'll call it. This isn't just any REIT. It's Singapore's oldest industrial REIT and one of the biggest on the Singapore Exchange. Think of it as the grandfather of Singapore REITs, but one that's still sprinting marathons. CLAR just dropped some impressive numbers for the first quarter of 2025. Portfolio occupancy hit 91.5%. That's like having 91 out of 100 apartments rented out. Even better, they achieved an 11% positive rental reversion. This means when leases renewed, rents went up by 11%. That's real money flowing straight to your pocket as a unit holder. But here's where it gets exciting. CLAR completed a massive $153.4 million acquisition through a sale and leaseback deal for a Class A modern logistics property. They also finished a $300 million redevelopment at Science Park Drive. These aren't small moves. They're strategic chess plays. The REIT also saw 2 asset enhancement initiatives completed, one in the US and the other in Singapore. Just recently, CLAR announced 2 more acquisitions, a data center at 9 Tai Seng Drive with a 7.2% yield, and a business property at 5 Science Park Drive with a 6.1% yield. Both properties are fully occupied. It's like buying a rental property that already has reliable tenants paying market rates. These purchases will boost CLAR's distribution per unit by 1.36%. Plus, there's room for growth. The data center can expand, and the business property's rent is 15% below market rates. That's future income growth baked right in. Now let's pivot to our second REIT, Mapletree Industrial Trust, or MIT. Picture this, 141 properties spanning 25.2 million square feet. That's roughly 440 football fields of real estate. MIT's portfolio is valued at $9.1 billion. We're talking serious scale here. MIT just made a brilliant strategic move. They sold 3 properties to Brookfield Asset Management for $535.3 million. Here's the kicker. They sold at a 2.6% premium to independent valuations. That's like selling your house for more than the appraiser said it was worth. Even better, these properties originally cost $438.4 million. MIT sold them for 22.1% more than they paid. That's capital appreciation in action. These 3 properties were the strategy, the synergy, and the Woodlands Central Cluster. The strategy and the synergy had occupancy rates of 82.1% and 71.6% respectively, while Woodlands Central boasted a higher occupancy rate of 95.5%. The sale strengthens MIT's balance sheet and gives them firepower for future investments. It's capital recycling at its finest, turning bricks and mortar into cash for better opportunities. These divestments should be completed by the third quarter of 2025. But what about office REITs? Everyone says they're dead, right? Well, our third REIT, Manulife US REIT, or MUST, is proving that wrong. Yes, they face challenges, but they're executing a smart turnaround strategy. MUST just sold their Peachtree Class A office building in Georgia for around $133.8 million US dollars. They're using the $118.8 million in net proceeds to pay down debt early. This isn't just damage control, it's strategic financial engineering. With this sale, MUST will have repaid around 78% of their 2026 debt. Combined with the earlier divestments of Capital in California and Plaza in New Jersey, they're systematically reducing their debt burden. Their leverage should improve from 60.8% to 57.7%, with their cost of debt falling from 4.53% to 4.07%. Think of it like refinancing your mortgage at a lower rate while paying down the principal faster. MUST is positioning itself for the eventual office market recovery. This disposal means that the REIT's portfolio will now comprise 7 properties with a net lettable area of around 3.5 million square feet. Finally, let's look at our fourth REIT, Elite UK REIT. This REIT owns mostly freehold properties in the UK and is the largest provider of infrastructure to the Department for Work and Pensions and other UK government departments. Government tenants are like having the most reliable landlord imaginable. As of December 31st, 2024, the REIT had assets under management of more than $2 billion. Elite UK REIT reported encouraging earnings for the first quarter of 2025. Revenue inched up 0.6% year over year to £9.3 million. Net property income shot up 24.4% year over year to £10.4 million because of a one-off lease surrender premium and dilapidation settlement. Excluding this one-off item, net property income would have increased by 4.9% year over year to £8.7 million. Distribution per unit increased by 9.6% year over year to £0.0076. The real excitement is in their expansion plans. With their expanded investment mandate, the manager plans to reposition 2 of their properties. The first is Lindsay House in Dundee, a vacant asset that can be repositioned into purpose-built student accommodation. The conversion will use the property's existing structure, which will reduce project costs and accelerate the asset's time to market. The expected opening of this student accommodation is September 2027. The other asset is a site in Blackpool, which can be developed into a potential data center. Elite UK REIT has submitted planning permission for this site, which is now in its final stages. Student housing is hot property in the UK, especially with limited supply. Data centers are the gold mines of the digital age. What makes these 4 REITs special? They're not just surviving. They're thriving through smart capital allocation, strategic acquisitions, and portfolio optimization. The broader REIT sector is showing real resilience. Interest rates have moderated significantly from their peaks, and inflation has declined substantially from its 2022 highs. This creates a much more favorable environment for REITs, which are sensitive to both factors. REIT managers have been proactive in reconstituting their portfolios and engaging in capital recycling activities to improve their holdings. This isn't passive management. These are active strategies to enhance value for unit holders. Looking ahead, the fundamentals for Singapore REITs are improving. The sector continues to be a reliable source of dividends for income investors navigating a complex macroeconomic landscape. With interest rates stabilizing and inflation under control, REITs are positioned to benefit from this more stable environment. For income-focused investors, these 4 REITs represent different strategies for generating returns. CLAR focuses on industrial and data center properties with strong fundamentals. MIT uses strategic capital recycling to optimize their portfolio. MUST is executing a disciplined turnaround in the challenging office sector. Elite UK REIT combines government backing with expansion into high-growth sectors. Each REIT offers a different risk-return profile, allowing investors to choose based on their specific needs and risk tolerance. The key is understanding what each REIT is doing and how it fits into your overall investment strategy. Here's what you need to remember. CLAR is growing through strategic acquisitions with built-in income growth potential. MIT is crystallizing gains while strengthening their balance sheet for future opportunities. Must is executing a disciplined turnaround that's reducing financial risk. Elite UK REIT is expanding into high-growth sectors while maintaining government backing. The REIT sector is staging a comeback. Lower interest rates, smart management, and improving fundamentals are creating opportunities for income-focused investors. These four REITs are positioning themselves to benefit from this recovery. The beauty of REITs is that they provide regular income through distributions while offering potential for capital appreciation. In today's environment, that combination is particularly attractive for investors seeking both income and growth. If you found this analysis helpful, smash that like button and subscribe for more investing insights. Drop a comment below telling me which REIT caught your attention and why. I love hearing from you, and your feedback helps me create better content. So, if you found this video helpful and want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. For your next watch, check out my video on 5 high-yield Singapore stocks for passive income, where I break down dividend aristocrats that have been paying consistent returns for decades. Until next time, keep investing smart and building that wealth.